I've worked in the financial services industry for more than 15 years now, and in that time frame, there have been two significant market meltdowns: the dot-com blow-up and the 2008 market crash. In both events, or in both scenarios, there was a lot to learn, a lot to take away for both individual investors as well as investment advisors like myself. In the dot-com blow-up, the big takeaway for me was the true power of the downside in the market. We had seen the 1987 crash over a few day period, but that rebounded fairly quickly. Actually, by the end of that year, 1987, most of the gains were made back. The dot-com blow up was something different. Quite frankly, the Nasdaq has still not gotten back to its level prior to the dot-com blow up. But the point being is the drawdown on these big blow ups, something to take notice of, because it shows you the true power of the downside. In this most recent crash, not only does the power of the downside rear its ugly head again, but what I really took away is that the vast majority of the financial services industry is not serving its clients well, whether it's misguidance, propaganda, old investment methods, or philosophies or strategies. And that really is what led me to starting Becker Advisory Services, or my own firm. Along that vein, what I've done is I've created an investment philosophy, an investment strategy, which I'm going to talk about very briefly to give you an introduction to how we manage money. The investment philosophy is underpinned here with 5 core tenets. The first one is to manage risk. What does that mean to you? Managing risk, or let's look at risk as it relates to investing. Risk when you're investing comes in many forms. You have inflation risk, interest rate risk, currency risk, single investment risk, political risk. There's many risks that we face as investors, and you have to manage that. How do you manage risk? Well, by investing in things that offset some of the risk. If inflation is an issue, then you look at things like gold and silver because they've held up well in inflationary environments. If interest rates rising or falling, you look at different types of bonds and so forth. There's strategies to implement versus just buying and holding a set number of investments. Risk can be managed if you understand what the risks are. My job as an investment advisor is to understand those risks and not necessarily plan for them, but address them in the portfolio. The second core tenet is limit losses. Why do you want to limit losses? Well, let me do a very quick mathematical calculation. If you have $100 and you lose 50%, you have $50. To get back to $100, you need a 100% return. 100% returns are not easy to come by in the investing market. And sure, some people can do it by taking high risks, but most people don't want to take those risks. So the point being is you have to limit those big losses when it comes to investing your own money or client money, or both for that matter. So limiting losses by having an investment strategy is very important, and I'll touch on strategy in a few minutes. The third core tenet is be global. The reason you want to be global, 2/3 of the world's largest companies are outside of the United States. A full 1/3 of the largest companies are actually in emerging markets like Brazil and China, India, and so forth. So you want to have global exposure. It doesn't necessarily mean you have to hold foreign stocks. It's beneficial to hold them most of the time, but you want to have global exposure, whether it's U.S. companies with large global reach or foreign companies, or a mix of both. But you have to be global. You cannot be home country biased and hold most of your stocks and bonds and investments in the U.S. The fourth core tenet is utilize ETFs. Exchange traded funds, acronym ETF. Exchange traded funds are a hybrid between a stock and a mutual fund, in that an exchange traded fund, the word fund, the similarity is there's usually a basket of underlying securities, whether it's a basket of stocks or bonds or a mix of both. Some ETFs just track one thing like gold or silver or some other commodity, but the overwhelming majority of ETFs track a basket of securities like a mutual fund does, so they're diversified. But they trade like a stock throughout the day. Typically a mutual fund, you can buy it once a day or sell it once a day, and that's the close of business. So exchange traded funds offer a lot of flexibility as well as efficiencies in trading. And quite frankly, for me, I don't have a lot of faith in mutual fund managers. The reason for that is you don't have to be a genius to look at 2002 and 2008 and look at the returns of most of the mutual funds, especially stock mutual funds, that well underperformed the market or went down as much as the market. So the question is, what are those guys doing in the bad periods of time? Just holding on to stocks, not trying to conserve investor money. So utilizing ETFs puts the control on me and on my firm to manage, again, the risk of the big losses. And you can step out when you need to, and you can come back when you need to. That's part of the strategy, investing strategy. The last core tenet, number 5, this is probably one of the most important ones, and this is to watch trends. The market goes up, the market goes down, the market goes sideways for long periods of time. You have bull markets, bear markets. These can last decades. So you have to follow the trends in the market. When the market's trending down, you don't want to take the ride all the way down. You want to have points where you get in and get out. And that's where investment strategy comes in. Our investment strategy is built along looking at fundamentals of underlying investments as well as the technicals. Fundamentals are, sales, price to earnings ratio, those types of qualitative information. And then on the technical side, it's basically analyzing charts because, believe it or not, a lot of your big institutions, matter of fact, all of your big institutions, pay attention to those charts and will buy and sell when certain things are met. So we look at the technicals as well. So for our investment strategy, we outline very specifically for ourselves through our strategy when to buy, when to sell, when to get in, when to get out, how much to put in when we go in, how much to take out when we go out. That way there's no guesswork. There is no quote-unquote market timing, trying to jump in and jump out at certain points. We've declared certain points the minute we get in, and we've declared certain points when we're getting out. So we know up front where we're going to be and how we're going to do things. So my hope is, as you've listened to this, if you're managing your own money, or you're paying somebody else to manage your money, you're reflecting and thinking about what that philosophy and strategy is. And if that's missing or you don't know what it is, perhaps we should have a conversation. Thanks for your time, and we hope to perhaps have a conversation with you at some point down the road.